The most expensive mistake you could make in 2026 isn't buying a home, but where you buy it. Welcome back to the Globe Realty. In today's video, 10 California cities where home prices are declining. The worst places to buy in California in 2026. We're cutting through the headlines and hype to expose what the data is quietly signaling beneath California's housing market. While many buyers still believe California real estate is untouchable, price trends, inventory shifts, affordability pressure, and migration data are telling a very different story. In this video, we'll break down 10 California cities showing early warning signs of declining home values, using real estate predictions and 2026 housing market indicators that every buyer and investor needs to understand. This isn't fear-bait. It's fact-driven analysis designed to help you avoid overpaying, buying into a weakening market, or mistiming your move. We'll reveal each city one by one, explain why prices are slipping, and what these signals mean if you're investing, buying your first home, or sitting on the sidelines. Watch until the end. The final city exposes a trend that could redefine California real estate in 2026. If you value clear, data-backed insights, like the video, subscribe to the Globe Realty, and turn on notifications. Your future finances may depend on it. Number 10. Oxnard, California. We begin this list with a place that sounds like a dream for many homebuyers. Beautiful beaches, coastal access, and a more affordable alternative to places like Malibu or Santa Barbara. But before you get starry-eyed, ask yourself this: does affordability still equal value in 2026? Because the numbers are starting to whisper something very different. Oxnard's housing market has long been known as a coastal entry into Southern California living. It's perched between Ventura and LA counties, and historically it's enjoyed modest appreciation. Yet, in the latest data, something interesting and concerning is happening. Several local price indexes actually show Oxnard's median home values flat to slightly down year over year. Zillow's Home Value Index reports typical home values down about -1.7% over the past 12 months, depending on the area tracked. You might be thinking, wait, didn't we just see prices up on some real estate sites? And you're right. In certain pockets or specific buckets of luxury listings, some sellers are still getting raised list prices. But here's the twist. When you peel back that surface level, homes are taking longer to sell. Inventory counts are creeping up, and price reductions are actually happening more frequently than buyers realize. That's not a hallmark of a hot market. It's a sign of slowing demand and market fatigue, even in traditionally coastal areas. Think about that for a second. Coastal real estate, the kind buyers usually believe never loses value, is now losing momentum. If homes sit longer and sellers start dropping prices to attract buyers, it tells you the balance of power is shifting. And when you're buying a home, momentum matters. So why is Oxnard here at number 10? Because while the headline still reads coastal, sunny, and desirable, the underlying data shows a market that's flattening and at risk of slipping. From rising days on market metrics to flat or negative year-over-year valuations, Oxnard's current conditions represent exactly the kind of scenario we warned about in this video. 10 California cities where home prices are declining. The worst places to buy in California in 2026, where buyer enthusiasm could be met with financial disappointment. Number 9. Modesto, California. Coming in at number 9 on our countdown is a city many buyers once saw as a safe fallback when coastal California became unaffordable: Modesto. And on the surface, it still checks some boxes. Lower prices than the Bay Area, single-family homes with yards, and proximity to job centers like Sacramento and even parts of the East Bay. But here's the uncomfortable question you need to ask yourself in 2026. Was Modesto's growth real demand? Or was it desperation demand? Because the data suggests that pressure is now reversing. Over the past year, Modesto home prices have flattened and begun to slip, with several housing trackers showing year-over-year declines or near-zero growth, and forecasts pointing to continued downward pressure into 2026. According to recent market data, inventory levels in the Modesto metro are up roughly 20 to 30% compared to the post-pandemic lows, while days on market have increased significantly, a classic early warning sign of a weakening housing market. Let's be blunt. Modesto benefited enormously from Bay Area spillover during the pandemic. Remote work pushed buyers inland, and prices surged faster than local incomes ever could support. But now that remote work is pulling back, commute tolerance is shrinking, and affordability is stretched, that demand is thinning out. Median household income in Modesto has not kept pace with the rapid price run-up of the last few years, and that mismatch matters. Ask yourself this: who is the next buyer willing to pay today's prices if the previous buyers are already maxed out? Another red flag? Price reductions are becoming more common. A growing share of listings in Modesto are seeing cuts before going under contract, which tells us sellers are chasing the market down, not leading it up. That's not a crash, but it is a correction signal, exactly the kind we warned about in the introduction of this video. And here's where it gets controversial. Modesto is often marketed as still affordable California. But affordable compared to what? When mortgage rates remain elevated and insurance, taxes, and utilities continue rising, monthly payments are still painful for first-time buyers, especially investors hoping rents will bail them out. Rent growth in the Central Valley has cooled sharply, limiting upside for cash flow investors. So why does Modesto land on this list of top 10 California cities where prices are declining? The worst places to buy in California in 2026. Because it represents a market that ran ahead of fundamentals, is now facing cooling demand, rising supply, and shrinking investor margins. If you're buying here in 2026, you're betting that yesterday's migration story comes back tomorrow. And the data says that's a risky bet. Number 8. Los Angeles Metro, California. A city many people believe should never appear on a list like this. Los Angeles. After all, this is the global capital of entertainment, culture, and high-paying jobs. So let me ask you a provocative question right out of the gate. If even Los Angeles is showing price weakness, what does that say about the rest of California? To be clear, this is not a 2008-style crash. But the data tells us something important is happening. Multiple housing forecasts now point to modest price declines of roughly 1 to 0.5% across parts of the LA metro through 2026, followed by possible stabilization. That may sound small, but in a market where the median home price still hovers around $900,000, even a minor correction can mean tens of thousands of dollars in lost value. One of the biggest warning signs, affordability. Los Angeles consistently ranks as one of the least affordable housing markets in the United States. Mortgage payments relative to income are stretched to historic extremes. When buyers are already at their financial limits, price growth doesn't just slow, it stalls. And stalled markets are vulnerable markets. Now layer in rising inventory. Active listings across many LA submarkets are up double digits compared to 2022 to 2023, while days on market have increased, especially for condos and entry-level single-family homes. Sellers are no longer in control, buyers are negotiating again. That shift alone changes pricing psychology. Here's where things get uncomfortable. Los Angeles is losing residents. Net domestic migration remains negative. People are leaving for affordability, taxes, and quality of life reasons. Yes, international migration and high-income earners still matter, but they're no longer enough to offset the outflow at scale. Less demand plus more supply equals pressure. And let's talk about costs beyond the purchase price. Insurance premiums, property taxes, utilities, and maintenance costs in LA have surged. Investors who once relied on rent growth to justify high purchase prices are now seeing rent growth flatten, especially in parts of the metro, flooded with new multifamily supply. If rents stall while expenses rise, margins disappear fast. So why does Los Angeles appear on a list like this one? Because LA is no longer a momentum market. It's a fragile equilibrium market. Prices aren't collapsing, but buyers who overpay in 2026 could be stuck waiting years just to break even. The controversial truth? In a high-priced market, even small declines hurt more. And Los Angeles is starting to prove that prestige alone doesn't protect you from math. Number 7. Santa Rosa, California. Let's talk about Santa Rosa, a city that epitomizes wine country living, scenic beauty, and for years, premium real estate. But here's the uncomfortable reality. Beautiful landscapes don't guarantee a bulletproof housing market. And right now, the data suggests Santa Rosa's once steady climb in home values is losing steam, enough that it earns the number 7 spot on this countdown. You might be wondering why this city of vineyards and charm. Because beneath the postcard image lies a market facing multiple headwinds that are now materializing into price pullbacks. First, let's get concrete. Recent housing figures show year-over-year median home price declines near 2 to 3%, depending on the zip code and data source. A notable shift for a market that typically saw steady appreciation. Couple this with an increase in active listings, up roughly 15 to 20% from pandemic lows, and you're looking at a classic supply-demand imbalance. More houses for sale and fewer eager buyers equals downward pressure. But what's driving that imbalance? One big factor is migration patterns. Santa Rosa has seen an uptick in listings from homeowners relocating out of state in search of lower taxes, cheaper living costs, or simply more space. When locals sell and the incoming buyer pool shrinks, prices must adjust. Another crucial issue? Insurance costs. Sonoma County, where Santa Rosa sits, has some of the highest homeowner insurance premiums in Northern California, driven by wildfire risk and reinsurance pullbacks. For many potential buyers, that's not a small footnote. It's a deal breaker. Higher ongoing costs mean a lower effective budget for purchase price, and that's a subtle but powerful drag on demand. Ask yourself this: would you pay a premium for a home if your monthly insurance is rising faster than your salary? Many buyers in Santa Rosa are answering no. And that's reflected in lengthening days on market and an uptick in price reductions. Now let's talk investment appeal. Santa Rosa once attracted investors seeking vacation rental or second home income. But with short-term rental regulations tightening, guest taxes increasing, and occupancy rates softening, that strategy isn't the sure bet it once was. Lower cash flow potential means fewer investor bids, another factor nudging prices downward. The most controversial takeaway here? Scenic beauty no longer equals market strength. In 2026, buyers must weigh ongoing cost pressures, shifting demand, and real economic constraints, not just charm. Santa Rosa's inclusion on this list isn't about doom scrolling. It's about real data and real risk. And if you're considering buying here in 2026, you need to ask yourself hard questions before you sign. Number 6, Clear Lake, California. When you hear affordable California real estate, Clear Lake often pops into mind. A place where homes were once seen as a bargain relative to the Bay Area or Southern California. But here's the hard truth twist. That bargain status is now colliding with real price declines and shifting market dynamics that most buyers aren't talking about. That's why Clear Lake lands at number 6 on this countdown. Let's look at the numbers. Recent Zillow data shows that median home values in Clear Lake have fallen by over 5% in the last year, despite the broader narrative of continuing price resilience in many parts of the state. Even sites like PropMetrics show a year-over-year price decline of roughly 5%, with forecasts pointing further downward through next year. Now ask yourself this: is a discount on paper still a deal if prices aren't reversing course anytime soon? Because falling home prices often reflect deeper issues, not bargains. Here's the second uncomfortable truth. Inventory is piling up, and homes are staying on the market longer. Days on market have increased significantly compared to recent years, meaning sellers are competing harder for fewer buyers. That's a classic early signal of weakening demand. The opposite of what you want if you're locking in a mortgage at today's rates, and it gets more interesting when you compare different parts of the area. In nearby Clear Lake Riviera, median sale prices were down nearly 15% year over year, with homes taking much longer to sell than the prior year. A stark reversal from the fast-moving market narrative many agents still sell. Some neighborhoods like Clear Lake Oaks have seen even steeper declines, with median prices down 20% or more depending on the submarket. Let's connect that to real investor math. If you're buying expecting appreciation or quick equity growth, you're now entering a market where values are shrinking and renters aren't necessarily covering the gap with higher rents. The median rent in Clear Lake isn't climbing fast enough to offset dropping home values, and that squeezes cash flow investors hard. Here's the controversial takeaway. Clear Lake's deal image is fast becoming a trap for uninformed buyers. It's one thing to buy at a lower price, it's another to buy into a softening market where values are still sliding. If you're thinking long-term, you must consider whether this decline is a temporary blip or a sign of deeper economic challenges that could keep prices under pressure through 2026. If you are finding this video eye-opening, do me a favor and hit that like button, subscribe to the Globe Realty, and turn on the notification. It will help us reach out to more people who equip themselves with real insight into real estate before investing. And now, the top 5 on this countdown. Number 5, Eureka, California. Halfway through our countdown, we land on a city many buyers don't think twice about, Eureka, a coastal, Humboldt County town known more for its rugged scenery and historic Victorian homes than headlines about real estate corrections. But don't let the postcard views fool you. When the data starts moving south, even markets you didn't expect make this list. And Eureka is a prime example of why in 10 California cities where prices are declining. Here's the first eyebrow raiser. Redfin data shows Eureka's median sale price recently down around -15.7% year-over-year, with a median price near roughly $370,750. A sign that homes aren't just softening, they're retracing hard-earned gains. Pause for a second and ask yourself, if a coastal city with lifestyle appeal is losing this much ground, what's that saying about demand? Because typically, places with natural draw and lifestyle premiums hold better floor value. But that's not happening here. Adding to the concern, PropMetrics data shows median home values in parts of Eureka declining around 6.5% YoY, with further downward forecasts, and homes sitting on the market longer, about 61 days on average. That's not market strength, that's a loss of urgency. Why is this happening? Several factors are colliding. 1. Remote location. Buyers are increasingly prioritizing commute access, jobs, and convenience. Eureka's remoteness, once a charm point, now looks like economic isolation to many buyers. 2. Buyer migration. Northern California overall has seen outflows of younger buyers and families to more affordable regions or Sunbelt metros with stronger job growth. High living costs, taxes, and insurance concerns contribute. 3. Supply pressures. Listing data shows inventory rising and sale-to-list price ratios weakening, in some cases homes selling below asking price, underscoring a market where sellers are competing for a shrinking pool of qualified buyers. And here's where it gets controversial. Eureka's decline isn't just a mild ebb. It's symptomatic of a deeper shift in buyer psychology. As affordability collapses under rising interest rates, high property taxes, and ongoing insurance challenges, especially in coastal risk areas, buyers are saying no thanks, even in markets once perceived as undervalued. Is this a crash? Not yet in the dramatic sense, but declines this steep in a market once considered stable signal risk, not opportunity. Buyers who ignore this could end up underwater or holding homes far longer than expected before seeing real equity growth. So why is Eureka number 5 on this list? Because even charm and coastlines can't save a market where values are slipping, buyers have leverage, and long-term demand is weakening. Number 4. Ukiah, California. A smaller inland city in Northern California that on the surface might seem like an under-the-radar opportunity for buyers priced out of coastal markets. But here's the uncomfortable truth. Ukiah is now showing signs of real, measurable weakness in its housing market, which is exactly why it ranks number 4 on our list of the worst places to buy in California in 2026. Let's get straight to the data. Recent market reports indicate that home values in Ukiah are expected to drop around 7 to 8% by spring 2026, one of the steeper declines among smaller California metros. Zillow's Home Value Index shows median home prices softening significantly from their post-pandemic highs, and the trend isn't slowing. Ask yourself this: why would a city with relatively affordable housing be declining this sharply? A big factor is supply and demand imbalance. Ukiah has experienced rising inventory levels over the last 12 months. Homes are staying on the market longer, and sellers are increasingly reducing prices just to attract buyers. The typical days on market for single-family homes has climbed past 60 days, signaling buyer hesitation. Another key driver is economic fundamentals. Ukiah's local economy depends heavily on agriculture, light manufacturing, and tourism. Job growth has slowed recently, and wages haven't kept pace with past housing appreciation, leaving many potential buyers priced out, even in a more affordable market. For investors, rental yields are under pressure too, as rents have plateaued while property taxes and insurance costs, especially in fire-prone areas, continue rising. Here's where it gets controversial. Ukiah has long been marketed as a hidden gem for first-time buyers and investors, but the reality is that lower prices are now reflecting risk, not bargain. Natural disaster exposure, aging infrastructure, and limited access to major job centers make long-term appreciation uncertain. In other words, what looks like affordability on paper may actually be a trap for uninformed buyers chasing short-term gains. Finally, consider migration trends. While some inland cities benefited from the Bay Area exodus during the pandemic, that wave is slowing, and many newcomers are opting for markets with stronger growth potential. This leaves Ukiah facing cooling demand against rising inventory, which compounds downward price pressure. In summary, Ukiah is on this list because it illustrates a key lesson of 2026. Affordable doesn't always equal safe, and smaller inland markets can experience sharper corrections than buyers expect. Number 3. Sacramento, California. Landing at number 3 on our countdown is Sacramento, a city often praised as the affordable alternative to the Bay Area. Yet the data tells a story that is far more complicated. If you're considering buying here in 2026, you need to ask yourself, is Sacramento still a growth market, or are you stepping into a cooling trend that could cost you? This is exactly why it appears on our list of top 10 California cities where home prices are declining. Let's talk numbers. According to recent projections, home prices in Sacramento are expected to decline around 3.3% over the next year, a noticeable shift for a city that saw double-digit gains during the pandemic. Zillow and Redfin data confirms slowing appreciation, increasing days on market, and a rise in price reductions, signaling that Sacramento's market momentum is faltering. You might ask, why would a capital city with such strong migration trends slow down? Part of the answer lies in pandemic-driven price spikes finally hitting affordability limits. Many Bay Area buyers moved inland seeking cheaper housing, but even Sacramento's lower-cost options are now stretching household budgets. The median home price is hovering near $470,000, which, combined with rising interest rates, property taxes, and insurance costs, is creating real barriers to entry. Another pressure point is inventory dynamics. Sacramento has experienced a rise in active listings over the last 12 months, coupled with longer selling times. Homes are taking about 45 to 50 days to sell, up from 30 days just 2 years ago. Sellers are increasingly reducing asking prices to compete, which indicates a shift in leverage from seller to buyer. This is particularly controversial because Sacramento has long been considered a recession-resistant market. Yet the reality shows vulnerabilities even in a government-driven economy. Economic fundamentals also play a role. While the city benefits from stable public sector employment, private sector wage growth is lagging, and household incomes are not keeping pace with housing costs. For investors, rental growth is flattening, and vacancy rates are ticking up, eroding the cash flow rationale for many buying for income. Here's the hard truth. Sacramento's image as an affordable, safe growth city is under pressure. Rising costs, slowing migration inflows, and the cooling market make it a city where buyers need to be extremely cautious. Sacramento lands at number 3 because it demonstrates a key trend projected for 2026. Even markets once thought recession-proof are not immune to cooling, corrections, and affordability pressures. Number 2. Stockton, California. Coming in at number 2 on our countdown is Stockton, a city that has long been marketed as a hidden gem for affordability in the Central Valley. But with 2026 on the horizon, Stockton is showing why even markets that once seemed recession-proof can become risky. Ask yourself this: is cheap really cheap if the market is headed downward? That's exactly why Stockton earns its spot on this list. The numbers are stark. Recent projections suggest home values in Stockton could fall by approximately 4.1% in 2026, which ranks it among the sharper downturns in California. Zillow's Home Value Index confirms that while prices surged during the pandemic, momentum has slowed dramatically, with median home prices retreating from peak highs near $450,000. But why the decline? One factor is oversupply and longer selling times. Stockton has experienced a notable increase in listings, with homes sitting on the market over 50 days on average, up from 30 days just a couple of years ago. Sellers are now facing price reductions to attract buyers, signaling a shift in market power from seller to buyer. This is significant in a city where rapid appreciation previously fueled investor confidence. Another major concern is local economic pressures. Stockton's economy has diversified since its bankruptcy crisis in 2012, but wages are still lagging behind housing costs. Median household income hasn't kept pace with rising mortgage payments, property taxes, and insurance premiums, particularly in areas vulnerable to flooding or other natural risks. For first-time buyers and investors, that mismatch is a serious warning sign. Investors also need to pay attention to rent trends. Stockton once offered strong rental yields, drawing in cash flow-focused buyers. Today, however, rents are plateauing, while vacancy rates are creeping higher, reducing potential income and making appreciation the main driver of ROI, which is now in decline. Here's the controversial truth. Stockton's affordability myth is under siege. Many buyers are entering thinking they are getting a deal, but with projected price declines and rising holding costs, it may be a trap for the uninformed. This is a city where chasing bargains without understanding underlying market trends could backfire financially. Stockton earns the number 2 spot because it embodies a clear 2026 trend. Even historically affordable California markets are vulnerable to corrections, especially when affordability collides with slowing demand, rising supply, and economic pressure. Number 1. San Francisco, California. At the very top of our countdown, and perhaps the most surprising inclusion on this list, is San Francisco. This is a city that has long been the crown jewel of California real estate. Iconic views, booming tech, and relentless demand. Yet for 2026, the data paints a very different picture. One where even San Francisco is feeling the pressure, and that's why it sits at number 1 in our top 10 California cities where home prices are declining. The worst places to buy in California in 2026. Let's jump into the numbers driving this controversial ranking. Multiple reputable forecasts, including from Zillow and broader market trackers, project home price declines in the San Francisco Bay Area ranging roughly from -2.5% to -5% through 2026 as part of a broader cooling trend in high-cost markets. This isn't wild speculation. It's based on real price movement data over the last year, showing a continued softening pressure on values amidst elevated mortgage rates, affordability constraints, and shifting migration patterns. Here's where it gets even more intriguing. While some microdata shows pockets holding and even moderate increases in select neighborhoods, that overall resilience masks the bigger trend. Across the broader Bay Area, about 80% of homes have lost value compared to the prior year, with the average drop significantly outpacing the national average. That's not a small blip. It's a structural signal that demand is being squeezed by real economic headwinds. Ask yourself this: how many buyers have been priced out of San Francisco for years, and how many more will be pushed out now that affordability is truly strained? Because the city's famously high median prices, often well over $1.2 million, combined with mortgage rates stuck in the 6% plus range, are now colliding with slower wage growth, tougher lending environments, and a buyer pool that's shrinking rather than expanding. Another headwind that rarely gets mentioned? Cost of ownership. Insurance premiums are rising statewide due to climate risk and wildfires, which hits high-value coastal cities hard and pushes effective carrying costs even higher. Now let's be real. San Francisco isn't crashing like 2008, but a projected mid-single-digit decline in home values in a city long thought impervious to corrections is a big deal. For potential buyers into 2026, that small percentage drop can mean tens, even hundreds, of thousands in lost equity compared to buying at peak pricing. This is why San Francisco tops the list, because the dream market isn't immune, and buying now without acknowledging this trend could be a costly mistake. And there you have it, our countdown of the top 10 California cities where prices are declining, the worst places to buy in California in 2026. From Oxnard on the coast to San Francisco at the top of the list, the data paints a clear picture. Even markets once thought untouchable are showing cracks. Whether it's affordability pressures, rising inventory, slower migration, or rising insurance and property costs, buyers and investors alike need to pay attention before making any moves. The key takeaway? Buying in 2026 requires strategy, patience, and awareness of shifting market fundamentals. Don't get caught chasing a deal in a market that's softening. Sometimes the smartest move is waiting, researching, and targeting areas with genuine long-term growth potential. We've gone through all 10 cities, highlighting the why behind each decline, backed by up-to-date statistics and real estate trends. If you're serious about protecting your investment and making informed decisions in California's evolving housing market, this information is critical. So here's my challenge to you. Don't just watch, take action. Review your local market, evaluate affordability, and consider how these trends could affect your buying or investment strategy in 2026. Share this video with friends or family who are planning to buy in California. It could save them thousands. If you found this countdown valuable, hit the like button, subscribe to the Globe Realty, and turn on notifications so you never miss crucial insights like these. And comment below, which city surprised you the most? And how will this information change the way you approach California real estate? Thanks for watching, and remember, in 2026, smart decisions come from data, not hype.